Guys, markets are massively overpriced based on history. Let's get right into it. As of January 15th, as of this morning, we're at 85% overvalued. The current S&P is at 47.83, and the fair value based on this overvaluation is 25.86. Now, look at history. The average 10-year return is 6.9% per year, not including dividends, okay? Where are we right now? The average stock market to GDP ratio should be about 0.94. We're at 1.733. Guys, the highest ever was 1930 at 2.5. The lowest ever was June of 1982 at 0.329. So right now, it's not looking pretty for stock market valuations. And there's a lot of people out there who would say, Paul, stock market GDP doesn't matter anymore because of blah, 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 blah. I get that. I absolutely understand the logic behind it. So let's take it one step further. Let's look at earnings, because earnings on a company doesn't matter where that money is generated. The biggest criticism of the stock market to GDP ratio is that it doesn't factor in money that's made outside the country. I'm not going to get into whether that's true or not. Let's just focus on the 10-year cyclically adjusted PE ratio. Mo, do you remember what that is?
So we take the 10 last year of earnings, bring it to today's, and divide it by the market cap.
Correct. Yeah. So we just take inflation, bring it into today, and guys, it's actually worse. 88.6% overvalued.
And now this one, as people say, the money made outside of the United States doesn't matter.
It doesn't matter.
Yeah.
Exactly. The company's reporting their net income across the entire world, right, and we're still at 88.6% overvalued. Now, you guys got to remember, we've been overvalued for a very, very long time. If you look right here, we're looking at this, and look how low it's been overvalued. We got a high of 102.2 back in September of 2021. So remember, what can drive this number down? Two things: stocks going lower or GDP going up.
Yeah.
What's probably going to happen is it's probably a combination of both. Because look at how much GDP, Mo, has grown just in the last since 2019.
Significantly.
We were at 21.7 trillion in GDP. Now we're at 27.6.
Yeah.
Why is that? Inflation.
Yep.
Because this is nominal GDP. This is the GDP, not including inflation. When you see reported GDP growth, that's usually real GDP growth, which means after inflation. But the nominal number here is not factoring in inflation at all. So this is some major growth. As an example, that's 30% growth in the last 4 or 5 years.
That's crazy.
Yeah. In the previous 4 or 5 years before that, it only grew from 18.4 trillion to 21.7. Yeah. Not much growth at all. 20% maybe. So that's the thing that really helps the stock market GDP ratio to come lower and lower and lower. Because even though we're pretty close to all-time highs, 47.83 is pretty close to all-time highs, we're actually at a rate, if you look, we're actually lower overvaluation than we were when the S&P was at 44.60. So the S&P is 8 or 9% higher than this point, but yet the over-under in terms of valuation is lower.
Right. That's
what's so great about these things working in tandem. And guys, it makes sense. If you think about it, an entire country's GDP, if it goes up, the biggest companies, the S&P, should go up along with it.
Definitely.
And this is what Warren Buffett calls the most reliable metric at any given time of where valuations stand. So you've got to remember, there's always reasons for why this doesn't matter and this doesn't matter. Great. But when we go back to the 10-year cyclically adjusted PE ratio, we're at 32.2 when the average is 17.1. That's a big difference. That's a really big difference. Now, here's what's interesting. You go back to 2001 or right after the tech bubble started to crash, the average overvaluation on the 10-year cyclically adjusted PE ratio is 54%.
Wow.
Yeah, wow. And ironically, the funny part is, with the stock market to GDP ratio going back that far, the average is 17% overvalued. So much lower overvalued.
Wow.
So it's funny to me that people criticize this one, and this one tends to show a more reasonable valuation. So what can cause this to, apart from stocks going down, because everyone wants to say, well, stocks go sideways for a long time, and they have. We're at over 2 years now of sideways movement in the market, right?
Doesn't feel like it, but...
No, it doesn't feel like it. Why? Because we've had a big drop and a big rebound.
Right.
So you sit there and say, okay, now remember, I do believe that companies these days can generate profits at higher rates of return than companies 100 years ago.
Definitely.
I absolutely acknowledge that. 100 years ago, if you want to make money, you had to build a factory.
Yeah, you had to build a railroad.
Yeah,
go across the whole country.
you had to build a huge factory, spend a
very
lot of money.
capital-intense.
Right. But now we have a lot of service-oriented businesses, software. They tend to have what's called a high return on capital. What that means is they don't have to invest a lot of money to generate profit. When you generate software, well, we have software in our community, right? We have software in this channel. Once we generate the software, it's about maintaining the software. We have to build a huge building. In fact, our developers, we don't have a single developer in our office. They're all scattered around the world, in the US and around the world. That's what's amazing. So we can generate high levels of profit. Versus if we wanted to build a widget, we have to go build a factory, hire a bunch of employees. We have to spend a lot of money before we can even turn the factory on.
Right.
And that factory has ongoing costs that are very, very expensive.
Right.
Now, our software has costs, don't get me wrong, but when
not
you,
not
correct.
like building a microchip.
Exactly. Now, guys, the good news is we've had reasonable valuations in the last, since the Great Recession. The Great Recession, back in December of 2007, based on history, market was worth about what it was worth. And then as it fell, it got as low as minus 37%.
Wow.
And look at that. When was that, Mo?
Assuming sometime in 09.
March of 09.
Yeah.
The low was March 9th of 09. Boom. Now, guys, the next 10-year returns, it is not coincidental that the highest returns occurred when the market was at its low. Yep. Let's go to massive overvaluation during the tech bubble. The highest level here was 56%.
Look at these returns.
Minus 2%.
Wow.
That wasn't the worst. The worst was right here back in March of 99. We got minus 4.4% over the next 10 years. Guys, we can, and this is only 55% overvalued. We're now at 85% overvalued. Now, what does that mean? I don't know. Because let's look at where we were 10 years ago. 10 years ago would have been December, let's call it December of 2013.
Okay.
December of 2013, we were overvalued by 13.5%, okay? Which would have expected about actually normal for what which would have expected a little bit under the average of 6.9%. But look, we did about 11%. Mm-hmm. But remember, it took a massively overvalued market to get there.
Right.
My guess is these numbers, as we go forward and forward, won't be as good as the last 10 years. Now, guys, just because market's overvalued does not mean there aren't good investments to have out there. So I want you to watch the next video where I talk about my top 30 stocks that I'd like to own.